Hi, my name is Sam and I'm an accountant with Martel Accounting in Dubbo. With harvest kicking off over much of New South Wales, I thought I'd put a quick video together to remind growers about the tax implications of using grain pools and how a grain pool can be used as an effective tax planning tool. To start with, we'll look at grain on hand or closing stock. Grain on hand is valued at 30 June each year, and it is effectively any grain a grower has in their possession at that time. So to give it a simple example, if a grower has $30,000 worth of wheat in a silo on their farm at 30 June, their grain on hand or their closing stock will be $30,000. The other side of that transaction will affect the income disclosed in the grower's tax return by the same amount. So to recap on that, even though the grower hasn't sold the grain, it's still disclosed in their tax return. Now there's three ways of measuring the value of their closing stock, so the amount that's disclosed in their tax return. The first is market value, the second is cost, and the third is replacement value. So why are grain pools different? So when grain is sold during the year, say at harvest time, November, December, the income from that grain is clearly accessible in that income year. When grain is on hand at the end of the income year, so it's unsold, as we mentioned before, there will still be some income disclosed in the grower's tax return at its closing stock value. However, when the grain is put into a grain pool, it's somewhere in between. It's not on hand anymore because it's not in the grower's possession. It's in the possession of the marketing firm in their silo. The grain isn't sold yet because the marketing firm hasn't disclosed or they haven't calculated yet what the distribution or the pool payment's going to be. So if it's not sold and it's not on hand, then it's not included as assessable income in that income year. So as you can see, there is some scope for tax planning. A grower may be able to use a combination of cash sales, cash payments, and pools to market their harvest. They might choose to put a percentage of their harvest into a pool, and the income from that pool won't be recognised in the current tax year, but it will be recognised in the subsequent tax year. This may allow the grower to gain a lower average tax rate over the 2 years. Deferring the income 1 year should also defer the payment of the tax expense associated with that income. That may also be an advantage to a grower's cash flow. This technique of deferring income to a subsequent year is especially effective if the grower is expecting a smaller year the following year, or that is a year with less assessable income. Now, some people compare farm management deposits with grain pools. Farm management deposits can also be used to defer taxable income to a subsequent tax year, but a farm management deposit has to be held for at least 12 months. A grain pool doesn't. The grain just needs to be in the pool at 30 June of the appropriate tax year. Now, there are several things a grower should consider when marketing their grain, and the tax implications of a grain pool are just one of those things. Now, I've attached the link to the ATO ruling, that's TR 2001/1, that is relevant to grain pools. Or if you'd like to contact me to discuss further, please give me a call on the Dubbo number, which is 0268 825922, or send me an email.